So the next topic that we are going to learn is what is auditor's liability. Now, firstly, what kind of liability does an auditor will have? It's not here what they're talking about is not the financial liability of an auditor, like the loans he takes. It's not, they're not referring to that. Here, when they talk about liability, is their requirement or their obligation to do something for the clients. Now, auditor, what he does, he onboards a client and performs audit function for the client. So he is entering into a contractual relationship with the client. Now, as per the contractual relationship, he has to fulfill certain services and he should not do certain things. To give you an example, criminal things like insider dealing. Like if I'm auditing, let's say, a Reliance company, and I came to know that Reliance is going to do something, come up with a new, market or a new division altogether, which could disrupt the society. I came to know that 1 month earlier. So what will I do? I'm working as an auditor for the Reliance. So I know they are going to do that. So what will I do? I will go and invest in Reliance company. Or I will tell some people, see, Reliance is going to come up with this. You invest in this. If their share price is increased by 20%, you give me a cut. That's insider dealing. Taking the unknown public information from the unknown private information, not public information, confidential private information from the company and getting benefit on that is called as insider dealing. Insider information is private confidential information within the client. And auditor goes and takes it and makes profit on that is a criminal offense. And auditors can also be found guilty when it comes to money laundering related issues, tipping off, etc. So definitely, if they are found guilty with respect to the these kind of activities with respect to the government, they will have a liability. They will be obliged to do this, and they will face a criminal offense, and they will be under jail term. Second is auditor has a contractual relationship with the client, which means if they breach the contract, then they can be sued. In addition to this, auditors have a duty to carry out the work with reasonable skill and care. They can carry out this work with reasonable skill and care. Negligence. To give you a simple example, doctors. Let's say that you went to a doctor and he did not, because he doesn't like you, he said, I am not going to treat you. That is against his Hippocratic oath. He's a punishable offense. That's number one. Second, he did not do things well, or he gave you medicines not as per the required matter, and you had severe issues. That is negligence. Or he did not do his surgery well, because of which you lost severe damages to your body. That's negligence. Similarly, even in audit profession, auditors are considered as financial doctors. They look at and investigate, break down the financial statements of the company and give an opinion and report to the shareholders. Now the shareholders will be taking decisions based on the reports that is given to the report that is presented to the shareholders. So what will happen? So if the auditors did not do their job well, and if the report is positive, opinion is positive, the shareholders might take a positive opinion. They might take a positive step. That can backfire. That is called as negligence. So there could be cases where, the shareholders might come up and say, because of you auditors, I'm facing huge loss now. So I am gonna, give a case against you. I'm gonna sue you for negligence act. But if the negligence can be proven as per the English law, 4 things should exist. Firstly, a due care, which is enforceable by law. In the contract, okay, I'm talking about the contract. If a client or a shareholder has to give negligence act, have to sue the auditor for under the negligence act, then 4 things have to be there. Firstly, there has to be a due care in the contract between the two parties, auditor and the client. There has to be a due care. The due care was breached. Like he can prove that the due care was breached. The breach was caused the injured party a loss. So we need to prove, the client has to prove that, okay, you know what, number one, there is a relationship and that auditor are supposed to enforce due care. Second, the due care was breached, like he did acts of negligence, he didn't do his work properly. Third, because of his negligence, I have suffered a loss. And fourth, the harm was not too remote a consequence of the breach. It was not too remote. It was not too remote. It was a severe issue. Only these four points you can prove. Then under the court of law, auditor can be penalized for negligence. So auditor can have a relationship with mainly two people. Let's say, for example, the client. Second, third parties, any third party. Let's talk about the client and the auditor. Does auditor and the client have a contract? Yes, they do have a contract. When they have a contract, duty of care exists. That is automatic. Based on the contract, the auditor are supposed to emphasize care and concern to the client. That is automatic from the virtue of the contract. Is that breached? The client must prove that the auditor have breached the contract. They have not given due care to the audit. Do you have a loss? That also have to be proved with evidences that, you know, because the client did, the auditor did not do this particular step or do this, did not perform this procedures, they did not identify this mistake due to which we had this problem. Is it not too remote? Again, that has to be proven. That has to be proven. So, for an auditor, if suppose he has followed the auditing standards, he has followed the auditing standards that is prescribed by IAASB. If it is prescribed by the IAASB and he has followed the ISA very well and he has followed the procedures according to his criteria, according to his conditions, he has followed the procedures. He has done that. But if that is the case, then definitely he can defend against his negligence. He can definitely defend against his negligence. If he is able to prove that as an auditor, I have done the procedures as per the required criteria and as per the standards, then he can defend against his negligence. But if he missed to perform certain procedures, then the client will be able to prove it. Like he, as per the ISA, this is what he's supposed to do, but he did not do this. Then he will be able to prove, the client will be able to prove that the auditor was under negligence. So that is how the client and the auditor relationship would work. Now let's talk about the third parties. Third party means anyone other than the client, the company, who wish to make a claim for negligence. Let us say that, you know, a bank asked for the auditor's report. The client company gave the bank the auditor's report. Bank, based on the auditor's report, gave a loan to the company, and the company now went bankrupt. Now a bank is giving a case against the auditor, stating that I looked at your audit opinion, it was true and fair, nothing was wrong. Now the bank is so because of that I gave a loan. Now the company is now under bankruptcy. So you only cheated me. Firstly, the auditor, did he have a relationship with the bank? No. The bank asked for audit report. The client gave the audit report. The auditor is not addressing the bank. Auditor, when in his audit report, he addresses whom? He addresses the shareholders. He has not performed any specific procedure for the bank. So because of that, whether the duty of care exists, it has to be proven. So if the auditor performed the services for the specific person, specific third party who is suing, it has to be proven. It has to be proven. If there is no contract between the third party and the auditor, then it is going to be difficult for him to prove. Like there is no contract, I am not serving, auditor is not serving the bank. So it's not going to be easy to be proved. Rest of the remaining cases remains the same. Like all breached, whether loss arising not too remote, it has to be proven in the court of law that auditor did not perform his procedures well, due to which these things happened. That's what they proved in the case of Arthur Andersen. they were supposed to save certain documents and submit in the court of law, and Arthur Andersen were not unable to do that. They were supposed to perform certain procedures and Arthur Andersen failed to do that in case of Enron. Due to which negligence was proven, their the audit firm was completely wound up, completely closed. That's what exactly happened in case of Arthur Andersen scandal. So, to tackle such issues, let's say for example, when an audit report is being issued, and specifically for a public limited company, anybody can read the audit report, right? A person who is conducting a business with the client, he can read the audit report because it is available in the public market, in the stock market, in the stock exchange, it is available. He reads the report and does business with these people and they lose money. What happens? So because of that, due to that such issues, what does our auditor have started doing? Auditor have started to protect himself. Auditor have started to protect himself. How he has started to protect himself? He has started to give disclaimers. And in December 2022, okay, in December 2022, sorry, 2002, not 2022, December 2002, PricewaterhouseCoopers announced that its audit report would carry a health warning that the opinion is provided solely for the benefit of the shareholders and expressly disclaiming liability to third parties. PwC's decision was prompted by the case of July 2002 Royal Bank of Scotland versus Bannerman Johnstone Macleay, where RBS sued Glasgow auditor to reclaim a lost loan, which it said it had offered based on information included in the auditor accounts. The judge found in favor of RBS. The judge said that disclaimer would have been made it impossible to infer the auditors had assumed a duty of care to the bank. So see, same situation I told you. If the auditor gives an audit report and the bank looked at the audit report and gave a loan to the client went bankrupt. Now, because of the client went bankrupt, the bank is saying, you know what? I am going to file a case against you. That is called as clear case of negligence. And the judge in 2002, July 2002, gave the case in favor of RBS. They said that the disclaimer would have made it impossible to infer that the auditors have assumed duty of care to the bank. So you should have kept a disclosure. But ACCA does not encourage this inclusion of blanket disclaimer clauses in audit response and believes that they are unnecessary to protect the auditor's interest where an audit is properly carried out. So look at this case. Right? It's a very interesting case. It's a very interesting case. Why? Because, see, the bank is saying that I gave loan because looking at your audited accounts. And now I have lost the loan. And the judge in favor of RBS gave this. And because of that, PwC has started to give a healthy warning as a disclaimer. So these things have happened, these things have happened, and due to which due to which auditors have started to give disclaimers stating that our audit is specifically for the benefit of shareholders and expressly disclaiming the liability to third parties. There was also another case which I would like to bring into your attention. It's called as a Bannerman case. The Bannerman case. This also has clearly created a big issue. I'm gonna bring that to the forum here. So look at this. Exhibit 1 in Bannerman clause, the following statement is typically placed in the other information section of the audit report. It is not part of the audit opinion. The report is made solely to the company's members as a body in accordance with Chapter 3 of the Companies Act. Our audit work has been undertaken that we might state the company's members, etc. The fullest extent permitted by law. We do not accept to assume responsibility to anyone other than the company and the members of the company for our audit work, for this report, for the opinions have been formed. So this is called as a Bannerman clause. So Bannerman clause came in after the case that was taken against the Bannerman. Right? So similar disclaimers like this. Right? Similar disclaimers have been implemented in the auditor's report. Now this particular disclaimer, is it good or bad? For the auditors, to some extent it's good, because they are saying that, see, we are not liable to a third party. We were appointed by the shareholder. We are giving a report to the shareholder. If that's the case, if a bank is looking into the audit report and giving a loan, that's the case, then anybody can bloody give loan to the client, and if he loses the loan, they will come to us. That cannot be possible. So there were a lot of arguments against this. Right? I mean, arguments in support as well as arguments against this. Argument in support is that, the firm's responsibilities to the client will remain unaltered. Like, they know what are the duties, because the duty is not increasing. They know that they only have to give reasonable assurance. And it is benefit for the shareholders because they are the ones who are paying for the auditor. It will clarify the responsibility for the auditor. Because if he has to satisfy every single person who is the client have a stakeholdership with, it will be very difficult, and his risk will increase over the top of the roof. And there could be cases of expectation gap, which we will learn very shortly. There is an expectations gap. What is expected out of auditor is something great, but technically he is providing very less, and he is getting paid for what he is providing only. And it helps us to reduce the risk against someone suing us. But what about the negatives? Integrity. It might reduce the value of the integrity. As I told you, the auditor is considered as a financial doctor. So his opinion is something will be considered as a strong. It may be misinterpreted as an attempt by the auditors to protect themselves. Like post Enron scandal, like Arthur Andersen, just because they won't be able to close down their business, they were protecting themselves. Many auditors can misuse it. They would say, they don't provide, they didn't do the procedures very well, but they somehow showed it as if they did the procedures, and they will give a disclaimer in the report. But the company is a bad company, and people start investing, and the company starts losing money. But what will happen to auditors? If they come to auditors, they'll say, see, we have provided a disclaimer. So because of that, this disclaimer could be misused by the auditors. They could do audits without due care and diligence. And it may provide protection. For another, it might not be the case. For actual issues, it might act as a coverage for the auditor to escape the wrongdoings. To escape the wrongdoings, it might act as a coverage. So that's what people are suggesting. Okay. Now, what is a Bannerman case? I don't want to explain. I will give a document for you to read after this particular video. Please take a read of it. It's a very interesting case, a Bannerman case. So as I told you, ACCA discourages from auditors from using the disclaimer opinion, a standard disclaimer opinion, because they believe that the value of the report will decline. It will devalue the audit report if they start using the disclaimers. Hence, ACCA is saying that any person who's practicing a firm or putting up a firm for practicing have to have a mandatory insurance. So as per the criteria, insurance is mandatory, okay, in many jurisdictions for holding of the practicing certificates. For example, in UK, a firm whose total relevant income total relevant income exceeds 700,000. So UK, whose total income exceeds pound 700,000, he is required to have a PII, okay, professional indemnity insurance. So he is required to have a PII of pound 1 million or 25 times of the annual fee. 25 times of the annual fee. So whichever is greater, he needs to have that particular indemnity, personal indemnity insurance. Why ACCA is asking the practitioners to do this? Because the audit firm does not find itself with a liability that is too big for it to pay. Like someone would ask, file a case against the auditors, and they can the auditors might not have enough money to pay against them. So they have this insurance from which they can pay. Second, the client can be compensated for the error. Like, okay, let's say for example, let's say we made an error. Auditors, okay, it's not their fault. So, but still they were proven that, okay, this is what it is. They have an insurance. Second, it is their fault and they made a negligence and it was proven in the negligence, and now client is losing the money, right? Client lost the money. The client shareholder lost the money. So at least you can compensate for the shareholders because we have an insurance. You have an insurance. Okay. So what are the kinds of insurance you can have? Two kinds of insurance you can have. One is PII, that is called as professional indemnity insurance, which is insurance against civil claims made by the clients and third parties arising from the work undertaken by the firm. So civil claims means contractual related claims. Like auditor did not do this, auditor did not do that, auditor did not detect the fraud well, this happened, that happened, those kind of things. The second is Fidelity Guarantee Insurance, FGI, which is insurance against the liability arising through any acts of fraud, dishonesty by any partner, director or employee in respect of the money, goods held trust by the firm. So Fidelity Insurance is protection against, for the firm, it's a protection against their partners. Because the partner is considered to be a fraudulent guy. He tied up with the client and did some insider dealing. What will you do? And because of that, the shareholders lost huge money. What will you do? Right? Or an employee did some insider dealing, or he was doing something illegal along by joining with the client. Now what happens? And shareholders found this, or an investor found this, and he sued the auditor that your employee has done this. So to protect against that, you have a Fidelity Guarantee Insurance. Right? So maybe the employee looted some money from the auditor and went away. What will you do? What will the audit partner will do? Or what will the audit firm will do? He has to protect himself. The company will sue the auditor only. The employee has left. What kind of employee are you hiring? That's what the company will ask, right? So to protect against such issues, you have Fidelity Guarantee Insurance. And hence, ACCA requires that all firms have to have this PII and FII cases. At least PII you need to have, so that the client can be compensated and you also can have certain protection. Okay. And it says that the insurance must cover all civil liability. Business by the partners, director or the employees, and it should exist for 6 years after a member ceases to engage in a public practice. So even after you cease to exist in a public practice, let us say you have a firm and you have taken a PII. Now you have stopped practicing. It has to continue for 6 years. Because till then any case can come, right? After 2 years, 3 years, there could a case come. Now, after 2 years, the case could come, then you're saying, I do not practice, I don't have money, then what will you do? So it's better to have, even the public practice is stopped for 6 years, we have this liability. Okay. Now, the audit firms are usually a trade partnerships. Usually a trade partnership. So what happens? All partners are jointly and severally liable to the claims. Right? So if it is a partnership, if one partner makes a loss, the other partner is also responsible for it. Because it's a partnership firm. So firms like EY, KPMG, they have so many partners, thousands partners, they have million partners. How will they manage? How will they take insurance for all these people? Won't their insurance cost will be so huge? One way of doing this is in terms of incorporation. They are registered as limited liability partners. So to reduce the fidelity cost of insurance, fidelity guarantee insurance, premiums, etc., the term limited liability partners came into existence. Now, in this case, what happens is that if one partner is making some negligent, the other personal assets of other partners will not be at risk. Like it will be with only one partner. If one partner is doing something wrongdoing, his personal assets will be attached. He will be thrown out of the partnership. He will face the legal side, etc. Other partners or the members will not be liable. Will be liable to the third parties. So because of this, big firms are actually incorporating into LLPs. So when they incorporate itself, they are incorporating themselves as LLPs. Further, auditors can reduce the chances of litigation. How? Very simple. Do your work properly. Do your KYC properly. Accept only those clients which you feel that are of risk which you can bear. If I am doing a public practice, if I am doing a practicing as an accountant, as an auditor, then I am the solo practice. I will not go and accept a client which is a bank because it's too risky for me. So when you accept it, only accept those clients for which you can take a risk. Ensure the work you do is with of high quality. Inculcate quality management procedures, which you will learn in the next chapter. Compliance with the standards. If you are able to prove that all the international standards of audit have been completed and it has been proposed, whatever international standards of audit have been proposed by AASB have been implemented in the process of audit, then case of negligence cannot be filed against you. Because you have done the procedure. Whatever the IASB says, these are the procedures you have to do. You have done that. Do you have the evidence? Yes, I have the evidence. Save the evidences. Can you list down what are the procedures you do? Yes, I can list down. Can you show how the procedures have been done? Yes, I can show. Have you documented all the procedures? Yes, I have documented all the procedures. That's called as compliance with the standards. You perform of the audit work with utmost quality. Perform it very well. Do performance of the audit work. Don't cook up numbers. Many auditors, what do they do is that because of the time pressure, they will take some evidences and show it as if they have done the work and close it. They will try to make up documents as if they have done the work. And to tackle this, big four organizations, right, have, they take the hot reviews and cold reviews very seriously. After 2018, I think this hot reviews and cold reviews have had severe impact because 2018, 2020, Carillion, PCOAB, every country, they are making the regulations stricter for the auditor. And if they feel there is some negligence by the auditor not following the procedures, they are penalizing. They are not asking anything. You are penalized. Penalty. Pay $1 million. Pay $2 million. So, Big Fours have taken the quality management very seriously. There are quality control partners separately who are checking the work done by the engagement partners. If they find that certain procedures have not been done, the quality partner will give negative markings to the engagement partner, due to which his promotion, his growth, he can also be removed as a partner, he can be demoted, his fee income, everything will get question mark. His points will get question mark. If it is coming as unsatisfactory, will get question mark. So hence, quality partner will hit on the engagement partner. Engagement partner will hit on the head of managers, and the managers will hit on the head of the seniors. Seniors will hit on the head of the juniors. This is how things will work in terms of the quality process. So, liability limitations. So another way to protect with respect to incorporation is liability limitations. Even with PII and other means of restricting the liability, there is a great concern throughout the audit profession globally, remaining the risk to the firm, survival in the face of the claim, which still might exceed the insurance cover. So what if even they have taken the insurance, their maximum limit is only £1 million, but the claim is for 2 million. Do you have money? No. So one protection against these is to control the liability itself via agreements between the auditors and the client. Like they can have a capping of liability. Like if there is any negligence, or this is this case, under any claim they will have to pay only this much. That is called as capping liability. Like if something goes wrong, I'll sign an agreement with the client. If something goes wrong, my ultimate liability will be only £1 million, because that's what my insurance will pay for. Then there is something called as proportionate liability, where allows claims arising from successful negligence claims to be split between the auditors and the directors of the company. So if there is a negligence claim done by the auditors, and it is also in this claim, company are also under fault, and both of them are penalized, they can be split. So $2 million, I will pay 1 million, auditor will say I will pay 1 million, another 1 million you pay. That is called as proportionate liability. Proportionate liability. Now insurance is good, okay. Insurance is good because it protects the auditor. But what is the problem here? There has been problems where, something called as taking advantage of this particular insurances. To give you an example, in US, majority of the litigation due to the failure of auditors is because of the fraud. But in UK, majority of the litigation is where the failure to detect the company failure, like Carillion. Company was failing, they failed to detect it. Whereas in US, there was fraud and they did not detect. So what are they doing is, what are the opposite parties are doing is, they are trying to make the case linking to the US jurisdiction. And in addition, the hedge funds are major hedge funds. Okay, hedge fund is a investment portal where companies can get investment from these hedge funds. Hedge fund is similar to that of mutual funds, where various investors pool their money and they are invested in and that investment is actually investing in various startups. Once they're big, they get return. That is called as hedge fund. So hedge funds, what they do is, investors, they go and invest their money in investors. Investors are doing something fraud. For example, I'll give you an example of Go Mechanic. Go Mechanic did a lot of fraud, and their auditors, what did they identify? They didn't identify anything. Now who will the investors get the money from? They will sue the auditors, thinking that, okay, auditors have any which is insurance. So if there is a negligible case win, auditors will get insurance amount and we will take a part of the insurance amount, right? At least some return we will get. If they don't win, then no return on the funding, definitely. But if they win, the hedge fund, people, when they sue the auditors, if they win, percentage of the insurance they will get back, right? So which can be considered as a return also. So because of this, last few years, lot of suing has happened against the auditors because they have insurances, etc. Right? So to protect that also, we are stemming the litigation. There are certain cases which are taken in terms of litigation. like having a proportionate litigation, having a capping of liability, doing limited liability partnerships, and legal fees. If the lawyer of the losing party have to pay the legal cost to the winning party, such cases are all being proposed to stem the litigations, to reduce the indictment against the auditors. Because otherwise what will happen, if I am an investor, startup investor, and the startup need to be audited, auditors goes and audits the startup, and startup as it is will be very poor in terms of financial controls. An auditor does all this hard work to audit the firm, audit the startup, etc., and they somehow don't materialize. What will the investor do? Okay, we need to somehow get the return, sue the client, auditor, and he will have insurance. What will happen? Insurance money will be paid to the investor, and investor will get some return from the startup. That's how they are trying to do. That's just a wrong thing. It's a negative thing of having an insurance as well. And this leads to the question of expectations gap. Like, there has to be clear case where what is auditor liable about. You cannot make auditor liable to prevent and detect fraud. What is his liability? His liability is only in relation to errors in the financial statement. But there is clearly debate and continuing occurrence of the financial scandals where auditors were being penalized, stating that there is a fraud. Auditor did not detect. He has done all the procedures he can, but the person who is committing the fraud is so good that he was hiding the facts. So how can this expectation gap be reduced? Where there is a difference between what is expected upon the auditors versus what his actual work is. He cannot assume management role. He cannot be responsible for everything the management does. His clear case is that he has only certain kind of responsibilities. But general public don't know that. General public will be like, oh, you know what, the company failed, let's sue the auditors. So to make them understand is definitely education. So the audit report has outlined in ISA 700 forming an opinion on financial statement now includes an explanation of the both management and auditors' responsibilities. So in the audit report itself, they clearly mention what are the responsibilities of the auditor, what are the responsibilities of the management. Even when they are signing the engagement letter, it is very clearly mentioned what are the responsibilities of the auditor, what are the responsibilities of the management. Auditor is not responsible for prevention of fraud. It is the responsibility of the management. And the fraud has happened. It has been reported. Now don't come and sue me. Extending the auditor's responsibility. Research indicates that extra work by auditors with inevitable extra cost is likely to make little difference to the detection of fraud. Because most material fraud involve management. See, poor guy, this auditor does all his work to detect fraud, but technically the entire management is under fraud. So his work, for whatever fee he is charging, he has to do extra. So there's no point in him doing extra because the fraud is done by the management themselves. More than half of the fraud involved misstated financial reporting. Like I told you, Go Mechanic. Managements were clearly aware that they are doing misstated financial reporting because they wanted to overstate their revenues. They classically created wrong evidences to show that. Why? Because their investors are under pressure. They have a targets that they need to meet and they are unable to meet it. So what they will do? They will falsify the target so that their valuation will not be compromised. Management fraud is unlikely to be found in a financial statement audit. It is not easy to find where a management is doing a fraud. It's very difficult to find in a financial statement audit because he's just looking at the financial statement, looking at the evidence. That's it. He's not sitting down to identify fraud. He's just doing procedures which might help them to identify the fraud. He's not sitting down and doing clear case of investigation. Far more is spent on investigating and prosecuting fraud in a company than on its audit. Suggestions for expanding the auditor's role have included requiring auditors report to boards and audit committees on the advocacy of the controls to prevent the fraud. So there have been suggestions where auditors' role can be increased to give opinions on the controls as well. Encouraging targeted forensic audit reviews. Like auditors should also do, apart from audit services, they have to do forensic audit services as well. Increasing the requirement to report suspected frauds. Like increase, if you are suspecting a fraud, try to report that somewhere. Make requirement to report that somewhere, to somehow to those charged with governance or to somehow to the management. Try to give certain requirements in relation to the reporting of the fraud. Right. So hence, it's very clear that there is a huge gap of expectation, specifically after the Enron case, because Enron case was a big hit to the auditors. Till then, they were like, some experts who feel that, they know everything. But after the Enron scandal, it has been quite a lot of scrutinization that has happened on the auditors. Because it's been proven that, an auditor and management together is indispensable and can commit a lot of fraud against the shareholders. So because of that, the expectations gap have been clearly increasing, and more expectations is being dependent on the auditors. That's what is exactly happening.